we were discussing about the financial crisis, and the financial crisis we have touched upon from a broader perspective the advanced economy experience, and actually we came to the point where we were highlighting different stages of the crisis that the advanced economies experience. And specifically, as we were highlighting all throughout, what you have to very seriously keep in your mind is that when you are looking at a financial crisis, you have to keep certain features always in your thinking. So one is large disruption to information flows. Please, that point is very important to remember. Large disruptions to information flows, because markets are, as you already studied, two-sided. One side is always buying, other side is kind of selling. If not, assets are demanded, assets are supplied. So if you see the markets are functioning, both sides of the market has to function, right? So this large disruptions to information is very important, because at times of crisis, what you simply see is only one side, often a seller, if not supplier side exists. Demand side often do not exist. If not, you will see very limited demand, and at times this demand also created by a regulatory, if not state or so-called Keynesian style policy directions. Okay, so what you are basically seeing is, when you see a financial crisis, one of the key elements that you will come across immediately is the disruptions to information flows. So these financial markets become one-sided because information with respect to the other side is not available. If not, even if the information are available, the trustworthiness of, or the confidence in such information, whatever available, is also very low, if not limited, because markets are doubting whatever the information available in the market at times of financial crisis. Okay, so then you see with this, the so-called financial frictions expands, and then of course markets even come to standstill, like stop functioning. And you have experienced there are blackouts in financial markets simply because of this type of circumstances. So that element is very important to remember. And as we move on, we have seen factors that causes this financial crisis, and also we looked at so-called dynamics in advanced economies, where the stage 1, stage 2, stage 3 we discussed. So I would not necessarily spend much time on detail in these things again. But one element is, we just mentioned debt deflation last week. When you say debt deflation, what you basically understand behind such a possibility is, when the markets are basically one-sided, if not not functioning, and also what you basically see is economies are heading to recession, if not already in recessions, and the inflation are in negative territory. That means prices are not necessarily increasing, but prices are basically tomorrow's prices are cheaper than today's. Okay, so that is deflation. So when you see debt deflation, what happens there is, when everything else is reducing, your liabilities, that's the debt that you are carrying in your portfolio, so your liabilities look day by day much bigger, and this is economic cycle recession based impact on your already established liabilities. So your debt become magnified in your portfolios. That means the liabilities become magnified, and as a result, your ability to service them even become remote. So this is very important element that you probably come across even at sovereign levels. That means at country levels, where the governments also start defaulting at times of financial crisis. Right. So we stop basically at this point and we can continue from there. And you can put these elements of advanced economies experiences into all these stages that we discussed. First stage, second stage, and the third stage, where the initiation of financial crisis you have seen there. So you see all these elements, balance sheets are deteriorating, balance sheets become weaker here. So you can figure it out, everything else being constant, your balance sheets become weaker means your ability to come out from the crisis also get postponed, if not become much harder, because you can't expand new loans because your balance sheet is weak. Even if you ask for a new loan from a financial intermediary, what happened there is financial intermediaries see that your balance sheet is weak. So the ability that you will get the full amount of finance is also get restricted when you see a possibility like this. Then you see from another perspective, as we were talking about so-called asset price boom bust cycles, asset prices also decline. Okay, so you see asset prices also decline, and when asset prices decline, immediately you come across a circumstance where the collaterals that you can keep with the financial intermediaries for financial transactions also get reduced. If not, you probably have to kind of compensate such possibilities with higher interest costs. Okay, at times of financial stress, you generally try to see that interest rates are declining, but what you simply see is when your risk levels are increasing, you probably end up paying more than what you used to at normal times because of the weakness in your balance sheet and then whatever assets that you have. And generally across countries, the empirical experience is that the asset prices decline by 1/3 across the circumstances of a greater financial crisis that we probably be discussing in this section. And then uncertainty. Okay, how quickly you can come out from the problems, how the economy is performing, whether the economy will revert back to so-called positive growth territory. Right, all matters here, but uncertainty will paint a bleak picture. So you are clouded, right? So whoever wants to invest, right, get discouraged and disheartened by not seeing a recovery in sight. So they see everything is bleak. So you can't kind of put their effort, expand, get new resources to employ, very difficult. So you see at the initiation stage, these elements are come into play, and effectively what it contributes is possibilities that adverse selections pop up. So even if you have a desire, probably you find that your selection would not necessarily be right because all these agencies are having difficulties. But at the same time, the information that you have with you now for evaluation and whatever assessments are not necessarily be of real market determined kind information. For instance, price information, you probably see prices not necessarily determined on a regular transaction basis, but maybe at a particular point of time, if not artificially popped up by regulatory actions, if not governments or the central banks, or for that matter treasuries, play a role in asset buying elements where you create a price for markets to function. Those prices are not necessarily reflecting market supply and demand driven circumstances. So you see these possibilities of adverse selection. And then of course you naturally have, when you selected the wrong party, the tendency that they get moral hazard intentions. So when you firstly kind of pull through your resource requirements through a possibility of non-revealing everything that you have in terms of actual circumstances, or you are not in a position to kind of come across pricing structures, you have more or less moral hazard probabilities. You probably take risks beyond what you should be taking, if not what you requires to take in terms of agreements, contracts that you have signed with the financial intermediaries, or for that matter, the principals' investments. So moral hazard, you're probably taking more risk. And of course, more risk is sometimes at times of difficulties being rationalized, because you have to take extra effort to kind of come out from the difficulties. So ultimately, anything goes wrong, that would magnify in the organization, and somebody else has to bail you out. So you naturally kind of see it is not necessarily something on your own investments. It is a third party's money or investments in the organization, or for that matter, principal agent problem. So the agents, that's executives who run the organizations, would try to kind of maximize their benefits and take moral hazard positions. So what it end up is worsen, and moral hazard problems worsen, and then of course the lending contracts also get tighter. So that's what you probably see, tighter conditions being introduced at times of financial stress for normal, even for a normal kind of a financial transaction. So probably the financial intermediaries are also worried, and also the probability that they would not necessarily see the immediate circumstances of recovery that push them to kind of make decisions on the basis of tighter conditions. Interest rates could be charged, higher interest rates could be charged, and tighter conditions of collateral, and collateral monitoring on a regular basis, collateral evaluation on a regular basis, all is possible. So you see these elements coming into play at first stage itself. And then you move on to the stage 2, where the banks, financial institutions, or the intermediaries itself having difficulties. As you see, economic activity declines. So when the economic activity declines, you see new economic activities are not come out. So when you wanted to come out from a difficult circumstances, financial intermediaries or the banks would try to lend. When economic activities are not necessarily picking up, who is borrowing? Only the parties who are lemons, okay? If not, worsened institutions or the organizations would try to kind of come and avail financial intermediary services. But unfortunately, when the economic activity is not necessarily pick up, on aggregate, you probably see that less demand for new financial assets, new financial products, new financial services. So your ability to come out from difficult circumstances by expanding your portfolio, expanding your assets, because loans are assets in financial intermediaries books, becomes much more challenging. So you see the banks already having difficulties, they further move into positions where their circumstances become challenging. So this exposes banks NPLs, non-performing loans in simple parlance. So the banks NPLs could increase. So what happened here is, again, you push to a point where the banks might then, to come out under these circumstances, might relax a bit of their considerations, or being forced to relax. You have to lend, like what sometimes happened in Sri Lanka these days. So-called COVID-affected agencies, industries, straight away after so-called Easter Sunday in 2019 April attacks, where the tourism-related industries had difficulties. They had problems. Now COVID-19 related. So being forced to kind of extend facilities. So you basically extending facilities without necessarily going through proper procedures. And also the agencies who tries to get these facilities would necessarily hide their real true position. They try to kind of, hide the circumstances and try to get so-called low, cheap interest cost finances. Okay. Although they are in a position to service normal loan possibilities, they will probably show up with a kind of a difficulty and try to get these facilities. So you start, I mean, with the banks are already in difficulties, you are again get these banks to kind of, you know, extend facilities to agencies which are not necessarily genuine. And once you have this, moral hazard problems is naturally set in. So you first place, you avail these facilities with not necessarily right intentions, and then you try to kind of initiate from the beginning how to avoid settling these obligations, right? So this is what you probably see, so-called loans extended to farmers and agricultural sectors closer to elections. Often these farmers, from the experience of financial agencies, try to avoid settling them because it's part and parcel of so-called election pledges and things that you promise us prior to the general elections, like you say. So the situation is kind of, you know, something very similar under certain circumstances that we are experiencing now, and these banks gets kind of in difficulties. So that's why banks always try to kind of, you know, see their exposure to such risk being pass on to, let's say, central banks or the government through guarantees or kind of, you know, credit extended by central banks, and then they on lend. So the risk from bank side is to some extent limited, right? So this is the possibility. And then again, what you are simply seeing is the lending contracts get tighter. So what this results is, again, you've been pushed. Already your economic activity has been slowed down, difficult to come out because of uncertainty. You are again pushed to circumstances where the banks also not necessarily in a position to lend under normal circumstances. You've been pushed towards extending facilities, and the facilities availed also tries to kind of, you know, make it a moral hazard possibility, and then the economic activities get further kind of reduced. So you see the economic activities get again hampered, and then you move to a kind of a situation where the deflation arises. Okay, so generally when the deflation is there, prices decline. So you probability that even if you are ready to consume something, when you see the prices are now declining, so you probably see tomorrow's prices are cheaper than today's. So why should I buy today? I can wait till tomorrow. So you postpone your possible transaction. So what it means is so-called inventories pile up. In manufacturing, in other related agencies, the inventories pile up. New productions line get slowed down, if not delayed, because you don't see the goods that you have produced, services that you are availing being kind of demanded. So that get delayed. So this is very important when it comes to certain asset classes where you probably see these delays are by longer durations. Okay, so manufacturing of high-end products, okay, even for that matter, the manufacturing or the constructions related activities get postponed, because you probably see this declining prices has much more severe circumstances where the expectation build that future consumption would be cheaper than current consumption. So current consumption get reduced. So when current consumption get reduced, you probably see inventories pile up, new economic activities do not get off the ground, okay, that get delayed. So what it again drives you is to the circumstances of adverse selection and moral hazard possibilities, and lending contracts get further tightened, and you are pushed further towards declining economic activities. So you see the circumstances under stage 1, stage 2, stage 3, all kind of, you know, push towards the possibilities of adverse selection, moral hazard, and lending contracts, and downward spiral towards economic activities. So you see these effects. So when you see these effects across the economy, especially during financial crisis, somebody has to come out and give the confidence the economies to come and perform. So we will get into those as we move on, okay? But before that, we will get into precise financial stresses or the financial crisis the world has experienced. And before I move on, Any questions that you have on this area? You can note down if you have any clarification or questions that you have through chat section, so I can follow up and I can explain as we move on. Anyway, so you see these difficulties when the financial crisis is set in across economies, especially advanced economies. That's what we discussed. And before we touch upon the current, if not more recent experiences of financial crisis of 2008, I believe some of you all might have read and heard the so-called Great Depression. So this Great Depression is called as the mother of all financial crises, right? So you see this happening towards latter part of 1920s and then early part of 1930s. So this where the world has come out from First World War, right? So then they have experiencing so-called Great Depression, okay? And this Great Depression is very important from a very different perspectives, and you probably seen sometimes the pictures, a picture of a lady wearing a very kind of damaged clothes in the background, where with a little girl in her hand, and then of course seeing that the environment is almost sabotaged, and that's a impression of circumstance during the world at this Great Depression period. So there were a lot of difficulties of people losing employment and losing access to basic needs, and then of course long periods of slowdown in economic activities, economies heading towards greater recessionary periods, all were factored there, okay? So in the US, you probably see this Great Depression has wiped out the economic well-being by at least 1/3, and you will see these numbers as we move on, and you will see some elements in terms of how the markets responded. So the Great Depression towards late 1920s, particularly 29 to 31 period, like 33 is also the duration one could call it, from 29 to 33. So we see that stock markets during this period crash. Stock markets completely lost its valuation, and as a result, anybody who held financial assets have experienced that their financial assets are falling from the roof. So you probably see the values of assets held by these parties are basically lost by manyfold. And then bank panics. So during that period, there were no so-called insurance arrangements. We will come to those stuff as we move on. Bank panics are people queuing up in front of the banks to kind of pull their deposits, because they are not sure whether this bank would survive today, and tomorrow that's they would not be able to withdraw their money. So they queue up from early hours of the day to kind of withdraw the assets that they have kept in the financial intermediaries. So when you see bank panics and everybody is trying to withdraw their deposits, what happened there is the banks normally keep certain percentage of their assets in liquid form, and banks are compelled to increase the liquid form assets, and then of course banks are not in a position to extend normal financial intermediary functions in the form of extending loans or other financial related activities, and also the whatever assets financial intermediaries held with them are now required to be encashed or cashed by liquidating. So when you are in a situation like forced to sell, you are selling at prices much lower than what under normal circumstances you will fetch. So you see the bank panics that get really kind of magnified and push institutions into much more difficult circumstances. And then you see the circumstances where the stock markets have already crashed, further declining asset prices. You see the stock prices decline on a continuous basis. So even with the bank panics, further decline in stock prices means your net worth or your wealth from a broader perspective that we have studied is declining. So when your wealth declines, what happens is your ability to demand assets further declines and you kind of curtail your activity. So that's how it happens when the circumstances become not right for financial intermediaries and the market as a whole. And then as we were mentioning, the deflation. Okay, so you see the collaterals that you have used to secure finance or another form of debt is also decreasing in value. So you have given you have mortgaged to a house as a collateral for a financial intermediary service loan. Okay, now the asset prices are declining, the house price also declines. So what that makes that institution, the bank's balance sheets, bank's balance sheet look much more smaller because the asset they had in their portfolio is now small in value. I mean, value has come substantially low because of the market circumstances. So it's a deflationary in the asset portfolios bank held. The collaterals lose values, collaterals become useless at times, and then the NPLs started magnifying. So these were the circumstances during so-called great financial crisis. Okay, so you see a circumstance across these institutions during this period, and the agencies across the advanced economies, particularly US during great financial crisis, the Great Depression, going through in terms of their assets valuation and things like that. So then you see, as I was mentioning, stock prices, how during Great Depression period, the stock prices crashed. Okay. So the stock prices presented here as an index where they looked at 1929 as 100 index points, and that you see the stock market at a peak for this duration at the point of the financial depression, if not the Great Depression, started in 29. Okay, so they have taken so-called Dow Jones Industrial Average, one of the most sought after indices that looks at stock market performance in US. So this Dow Jones. So you see it's 1929 equals 100, then it's almost lose its value to like 10 index points. So it's like from 100, it has come to 1/10 of the values that prevailed in 1929 to 1933. So in a 4 years time period, you have seen stock market crashes. Okay, so if you had 1 million worth of stocks invested with the stock in this Dow Jones, what you are basically seeing is it's worth only 100,000 within 4 years time. So you have lost 1/9 of your assets during this period. So that shows how the stock market crashed. And then you see it has some recovery from 1933 onwards, but unfortunately it could not kind of, you know, climb back to a half of what you have seen in 1929. So not even touching 50. I mean, even up to 1940, that's where the Second World War started. And then you see another prolonged economic recession where markets could not really come out from any possibilities during that period. So basically, you are experiencing from all these elements that the stock market circumstance during the Great Depression. So you see it crashes from 100 to almost 10, and then some recovery, but not even half of that, very much settling around 30s, mid-30s up until Second World War. So you see the stock market crash from here, and then you see so-called spreads, credit spreads. So the spreads are like what I was mentioning to you all, what you place between two layers of bread to make a sandwich. So you see, spreads are whatever, the butter, the the toast, whatever that you place between your bread slices to make sure that your sandwich look thick. More thicker, what happen is you will not be able to balance the sandwich, and the sandwich kind of, you know, run around when you try to eat, or it falls down. So similarly, when you see credit spreads, the spread over the benchmark is US Treasury. Okay, US sovereign instrument is the most credit worthy asset at difficult times. So everybody tries to buy the US Treasury. So US Treasury yield rate, or the interest rate, and what's the interest rate that you are paying for other assets, okay, loans or whatever. So what you are basically seeing is BAA rated assets versus US Treasury being looked at. So BAA, you know what it is. This is for credit ratings that we were discussed in one of our lectures. So the level of BAA rated versus US Treasury, spreads have peaked to almost 8% by 1933, mid 1932 period. Okay, it was generally around 2%. So if the US Treasury is 4%, BAA rated assets are costing only about 6% under normal circumstances. But when you see it is 8%, if the US Treasuries are 3%, so these assets are costing 11%. So the spread has widened, continuously widened, and then see some direction of reduction, but could not come back to the 2% levels that experienced prior to the Great Depression. So what you are basically seeing is credit contracts worsen during this period. So you have circumstances where the assets being priced, lending were priced, so the lending rates probably gone up because of the spreads, because the uncertainty is greater. So the financial intermediaries are charging higher risk premium from these agencies. So you see these possibilities. This is spreading during the Great Depression period, and already seen the stock prices crashed, and now the credit spreads are widening to a very much high levels in its normal compared to normal market circumstances. Okay, so the Great Depression is now in the back burner. You know what it is, how it happened, and what driven the Great Depression. Any questions before I move on to discuss the elements that we are discussing in terms of the current or more recent financial crisis of 2007-9? Right. So you are seeing a circumstance here where the recent 2007-9 financial crisis. So you see a circumstance where the financial innovation becomes more of a regular, if not as market takes the financial innovations as quite normal during this period. That means new financial products, right? So the financial markets are so advanced in this period of time, where the new financial assets, new financial products being emerged every other day, like in market. So they've introduced new assets being produced to great extent to mitigate risk, if not to diversify the risk probabilities, and then of course to have higher return in terms of the assets that the financial intermediaries hold. So you see financial innovations emerge in the mortgage markets, because mortgage market was the US mortgage market was the epicenter of the financial crisis in 2007-8 period. So you see this innovation here. So then you see so-called subprime and alt A mortgages in US. Subprime is below the prime. So you can figure it out. When a financial intermediary lend, they have their portfolio being extended to more trustworthy, if not credible customers. You call it prime borrowers. So you lend them at prime lending rate. So if you look at central banks details being published on a regular basis, so weekly economic indicators and other related publications, you find so-called prime lending rate. So for each financial intermediary, they have their best customers. So what rate at which these best customers get financed is the prime lending rate. So the subprime is below prime. So the borrowers who are not prime, if not best customers, but below that level, sometimes you can call it even some risky customers and not creditworthy customers, they are in subprime. So they are getting at a certain rate, so-called subprime. And then you see alt A. Subprime is one element. So alt is alternative. Alternative A means you can have other alternatives A, B, C. You pool your portfolio. Okay, in US, the mortgage market functions in that way, where you see subprime people where they are not necessarily that credit worthy, but alt A, a little bit better, you can call it. Okay, so they are being pooled. Like, so when you have a customer pool, you separate one segment of that to subprime and the others to alt A. This is the mortgages. You have extended mortgages, you have taken collateral, or sometimes even without collateral, especially during 2006-7 period. Yes, financial circumstances in US has kind of pushed to a point where the mortgage industry was not necessarily looking into credible collaterals. They were extending mortgages to anybody who is having some access and possibility of showing them that he can settle the obligations on a periodic basis. They were kind of extending mortgages. Okay, so then you see this portfolio being extended to subprime and alt A circumstances, and then you see this gets to a point of creating so-called securities, so-called mortgage-backed securities. So you pool these assets that you see now in your portfolio. You have lent to the mortgage demanders. So you have pooled them into one basket, let's assume, okay, and created securities, so mortgage-backed securities. And then these being again sold back to, okay, another element of investors. So that means collateralized debt obligations. Okay, so what you are basically done is you have seen your portfolio. Within the portfolio, you have good quality customers, bad quality customers, average customers. You separated them, subprime, alt A, alt B, whatever other names you call it, you separated them. So you know the service obligations of these parties, right? Some must be settling their loans at 6%. Some must be settling their loans at 4%. Some must be settling their loans at 2.5%. So the 2.5% are the prime customers. 8% are the subprime customers. Average customers must be settling at 4% or 6%. So see this difference. So within a portfolio itself, you have pooled them and created so-called a mortgage-backed security. So you have now what you have done is you have got all these subprime 6% people into one basket, and then you know on a monthly basis, if you have 200 customers paying 6%, what your cash inflow from these parties for that particular period of time. So you have this element, so you pack them and sold this as a security to another financial intermediary. So that financial intermediary brought this by paying you, let's say, 500 million US dollars. Okay, so you got 500 million. Okay, what you have done is you have pooled these subprime people into one element and sold it to a financial intermediary B. You are financial intermediary A. So financial intermediary sold this pooled subprime paying customers, creating a so-called mortgage-backed security. You have gave it to another financial, where you got another 500 million. Now you have new assets of 500 million. For this 500 million, you are required to pay interest to the financial intermediary B, because financial intermediary invested in your security 500 million. So how you are paying this a financial intermediary B is, now you are getting 6% from these parties. You probably be paying, let's say, 5%, because you are a financial intermediary. You are having a reasonably high acceptance by financial intermediary B. So you are getting 6%. You are paying 4% to these parties. Okay, so 500 million being new security at 4%, you have now designed. So this is the financial innovation. Okay, so you define and design the new mortgage-backed security. So you got this 500 million and use this 500 million to again extend housing projects in US, because housing prices in US were one-way traffic during this period, increasing. Okay, it's always increasing. Tomorrow's prices are greater than today's prices. Day after tomorrow's prices are greater than tomorrow prices. So it's an increasing trend. So they have seen prices are continuously increasing. So even if somebody is defaulting, they can get the key, they move out from that place, so they can sell that after renovation to another party at a higher price. Okay, so that's where so-called mortgage markets is one-way traffic in US prior to the financial crisis in US during this period. So you have now created the financial asset, got this 500 million, invested that in a new project, and again started mortgaging that to another segment of buyers, people from rest of the world buying assets in US. Okay, China, East Asia, even the countries like low income countries, and then of course the commodity revenue based countries from Europe, they're all purchasing assets in US, right? So when you see a circumstance like that, so you see prices are one-way traffic, it's increasing all the time. So you are not worried, you invest, you see that return is every time you see a return. So you are blindly getting higher return in investing in property, real estate in US. So real estate prices are increasing on a continuous basis. So even what you have borrowed by pooling this subprime, the borrowers, you have created the security, got the money, and you are confident that you can pay the clients at 4% because they are paying you at 6%. So you are very much secured. So this is the kind of drive in securities. And this same thing was, again, I only took so-called subprime kind of customers. Then you pooled other alt A, alt B. They also had different kind of credit worthiness customers. So you pool them again and create another so-called security. So when you pool subprime, alt A, alt B, and have a bigger kind of a portfolio, you call them a kind of a collateralized debt obligation, CDO. And then this CDO works like different level of risk elements are pooled in a circumstance where you are paying different interest rates to the financial intermediary A. So financial intermediary A, by seeing these all, lend this, if not create a security and give it to some other financial intermediary in the market to buy this. So the financial intermediary B, C, D, whoever, not only US but outside US also, invest in this type of assets and they get serviced by financial intermediary A on the basis of what they are receiving as payments from so-called original mortgage payments by these parties. So it's a very good circumstances, as everybody was seeing that prices in the mortgage market, real estate market is increasing in US. Assume for the time being it is one-way traffic. So this is how financial innovations emerge, especially in the mortgage market, with a lot of new thinking in the economics and other related areas where financial engineering, we will talk about those stuff. So the people who have studied in engineering, sciences, pure sciences, are moving into the economics and financial markets and applying their mathematical and of course applied knowledge to create this type of financial assets, and these assets become quite popular in these markets. So this was the trajectory in which you are seeing you are starting 2006 2007 in US. So it's one-way traffic, assets are increasing, yes, and everybody was happy. And then of course you see so-called bubbles are forming in the housing market. That means the bubbles that you can create could blow, if not expand up to a point. Okay, so it is not necessarily prices of the housing market is increasing driven by economic fundamentals or other related macroeconomic circumstances or conditions. It is a bubble. Bubble could burst at any moment of time. Okay, so what you are simply seeing is partly the liquidity level, okay, in US, where the Federal Reserve, the US central bank, is also keeping interest rates low. So the borrowing cost is quite low for financial intermediaries from the central bank, and also money is flowing into US from rest of the world. China is increasing its purchases of US securities. The countries who has commodity exports are getting significant revenue from commodity exports are invested back in US, and the people who are now becoming rich because of expanding middle class and high income classes in rest of the world, emerging market, frontier market economies in East Asia, Europe, as well as in Latin America, even in Africa and Asia. So they are buying assets in US. So the demand for US is continuing in terms of real estate. So you see the bubbles are forming. So it is to great extent not driven by economic fundamental to see the asset prices to increase, but exceptionally high demand emanating from circumstances that could kind of turn around at any time would be driving, and also credit driven. So it is low cost financing available in US at low interest rates. So that also facilitated to great extent expanding the housing prices to form bubbles during this period. So this bubbles discussion is very interesting because Japan had a different experience prior to 1996-97 period, especially late 80s, mid 80s, late 80s, early 90s. The Japan had a huge price bubble, asset price bubble in Tokyo and related areas where all the real estate properties increased. Even the golf courses membership has kind of skyrocketed in values in Tokyo during that period. So what you are basically seeing is people invested all their retirement income in Japan during that period, but all of a sudden when the prices start reversing, it's one-way traffic, they lost all their income. Sometimes what they are seeing there is the retirees who invested all their life savings into real estate at the peak of this financial bubble, basically crashing down and even kind of taken bad, worse decisions of suiciding themselves because they don't have any assets left with them. This is like, the bubbles bursting point in Japan after the kind of initial rapid price increase. So in US too, by mid early 2000s, they are seeing this one-way traffic of asset price increases. Demand is always there, and everybody is seeing that prices are increasing. So nobody worried too much about what would happen if prices reverse, right? So even the liquidity levels in US was very high, simply because the interest cost of finances extended by regulators and other related agencies were kept at substantively low levels for longer durations, and also demand, as I was mentioning, coming from rest of the world. So this was the circumstances in US prior to the 7-9 period. Okay, so then the housing bubbles, we were talking about that. Basically, making prices to surge. Okay, and the housing prices is simply kind of seeing that tomorrow's prices are increasing, and expectation is always there. This increasing tendency would continue for a longer duration, and then you see gradually by 2005-6 period, so-called agency problems started propping up. So what effectively seen in US during this period in the mortgage market is the so-called originate to distribute model. So no financial intermediary, mainly the banks, does not hold the loans that it originates. As I was mentioning, the so-called mortgage-backed securities and CDOs model. So whatever that you extend in the loans, they don't want to hold that in their portfolio. Okay, but they distribute them to other financial institution after they have been repackaged and converted. As I was mentioning, different type of risk classes being pooled, different kind of risk classes being assigned a different kind of a product name. Okay, so being extended and facilitated to sell back to another financial intermediary or the market, financial market. So they do not hold the loans that they extended in their portfolio, basically pass on, and the financial intermediary who buys that, they also do not intend to keep them in their portfolio. They also try to kind of originate to distribute. So they also try to repackage and convert it and sell it to another financial intermediary. So it's circling across financial intermediaries and other agencies in US. CDOs were quite popular because you can now see the risk being channeled from you to the next, and thereby you are making a money. And at the same time, nobody precisely know what is the precise underlying assets for these loans that they have extended. So it is basically so-called principal agent problem, right? So the banks, investors, regulators do not expected that this to be distributed this wide. They wanted to see, okay, you can have a financial innovation, but this financial innovation should be with appropriate mitigative, risk mitigating measures. But unfortunately, agents, okay, in this case, executives or mortgage brokers, they were much more behind higher earnings. So they were basically trying to distribute whatever assets that they are creating. So this was the circumstance when the agency problem started kind of creeping up in the US financial system. Okay, so then the borrowers at the same time had little incentive to disclose information about their ability to pay. As I was mentioning, no proper evaluations also establishing in US because of the so-called agents were somehow wanted to sell the mortgage, if not real estate, to anybody who is now ready to kind of occupy a property in US, because you probably heard from different discussions or whatever that you are watching in TV or reading in newspapers. There's an American dream. Everybody wants to have a house as well as a motor vehicle, a big motor vehicle, big car. So it's a kind of a dream in US. So if anybody there, they wanted to see that they own a house. So it's like a American dream. So they try to kind of go behind this. So even the financial intermediaries during this period were not worried to see whether the person who is borrowing from them or mortgaging these assets with them is capable of servicing this loan, whether he has a permanent employment. And at times what now revealed in literature is that the people who worked in petrol stations as pumpers, they have basically crossed the borders illegally and settled for daily wages, if not hourly wages, for their living, right, being extended mortgage facilities, right? So the agencies were not worried, simply because the agents were maximizing their earning probabilities by taking excessive risk, right? This is the principal agent problem we discussed. And then, of course, from another perspective, borrowers also not worried to disclose everything, because they also felt, okay, if I'm not in a position to pay, I can just give the key to the developer and move out. So the developer whitewash, do a small renovation and sell this property at a higher price, right? Simply because, as we were mentioning, the prices were in a one-way traffic, only increasing in US during this period of time. So this has created a lot of so-called adverse selection all throughout. With the adverse selection, moral hazard is naturally established. So see, so what we have learned all throughout is repeating in these circumstances in US during this period. Any questions? Please, if you have any questions, you can just jot down them and pass it through chat so I can follow up while discussing. So that would make kind of understanding easy. So then, through these agency problems that we were discussing, okay, the commercial and investment banks, okay, were not really worried about assessing the quality of securities that been pledged also. Because if you are in a circumstances where prices are increasing, so you see that the assets being pledged for your financial facilities that you extend, you don't necessarily take serious quality assessment exercises. So quality assessing has been kind of put into a weaker footing, if not back burner in most of the cases, and they simply see financial facilities being extended to the borrowers without appropriately evaluating the collaterals being pledged, the possibilities of servicing this loan by the borrowers, all being kind of, not necessarily evaluated during this period. Okay, so then you see so-called information asymmetry. So-called information problems arise. So we see this information breakdown is mainly a problem, and that's where the financial crisis starts. So the information problems are now creeping up. So the agencies who lend do not necessarily have information of the borrower and the circumstances in which the borrower is facilitated in terms of financial intermediation. So these borrowers were not necessarily quality borrowers. That's why they call it subprime. There are quality borrowers, yes, a bigger share of them are quality borrowers, but unfortunately, when the subprime borrowers were basically expanding in US, and the circumstances that the agents, that the brokers, executives were not necessarily getting into the details of these borrowing and where these funds being channeled, because ultimately what they are simply seeing is if anything happens, they have the property which can be resold at a higher price, and also all the loans that they extended, they also not necessarily wanted to keep within the financial intermediary. They want to repackage and resell. Okay, CDOs, collateralized debt obligations. So when you see this type of probabilities building up, so the information asymmetry is building up in the economy as a whole. So when you are moving in that circumstance, when a price bubble bursts, it's like you are crashing down from the air. So you see the prices which are one direction, which is heading north all the time, but now all of a sudden reverse down and heading south. So when you see the prices are bursting, no way that you can see the markets establishes its demand and supply kind of circumstances. We can see these type of things, okay? But then these prices collapsing in US has not stopped only in US. It started spreading rest of the world because US financial intermediaries have globalized. So as we were mentioning, CDOs being invested by rest of the world financial intermediaries too. And when you see people who have gone and purchased these assets in US are not all US citizens, but people who wanted to go and purchase these assets, and also some of these assets being purchased by the new rich spreading throughout rest of the world, rich class, if not the middle income class, expanding all throughout. So they also have gone and purchased. So these were crashing down. Their net worths are declining because of the asset prices that they had in their portfolios are coming down. So you naturally see a circumstance where the financial markets are now stressed out, not only in US, but globally. Okay, so what you are basically seeing here is the spreads that we were talking in the Great Depression period, like TED spread. We will come to TED spreads in a moment. Okay, that is 3-month interest rate on euro dollar. Euro dollar means US dollar loans extended outside US is euro dollar. Okay, so you see 3-month interest rates on euro dollar minus 3-month interest on US Treasury bills, which were around 40 basis points, not even a half a percentage under normal circumstances, increasing to 6 times of that, 240 basis points by August 2007. TED spread. That's the kind of borrowing in US dollars within US versus outside US. So euro dollar rates, 3-month US dollar financing outside US was based on the TED spread that we are talking here. That's the price that you are paying for borrowing outside US is 6 times expanded during this period in August, when the market started kind of showing signs of collapse, where the bubbles in the housing market start bursting. So everybody else who invested here is now feeling the pain, and the financial intermediaries who have linked up with US financial intermediaries and US financial intermediaries who have spread it out to the rest of the world, okay, are now feeling the pain of financial market distress. And see, with this immediately, the balance sheets of these financial intermediaries are now weakening. Your assets, whatever you held as collateral, are no value, collapsing in value. Okay, all real estates you had is collapsing. You have lent to many high net worth individuals. The net worth of these individuals are crashing simply because they had assets in mortgage market. These assets are losing value. So then banks have to write down because they don't want to carry a very low value assets in their books. So they started writing down them. So basically, uh, 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 no value in the collaterals they had. So take out those collaterals at least to clean your balance sheet. Okay. Then of course they started selling assets because of the liquidity requirements. So it is a fire sale. When you are selling, when everybody else is selling, there is no buyers, so you don't get a right price. You also get a very low price for your assets, so you are forced to sell to build some buffers. But unfortunately, when the market in one side all are selling, so you don't necessarily see you are receiving a good price for the assets that you are trying to liquidate. And then you see so-called credit restrictions. You are not in a position to extend further facilities because your balance sheet is weakening. So you don't have much big balance sheet to talk about because your credit already extended credits are losing in value and collapsing in collaterals and other formalities. And you see this is happening all in US and in rest of the world who are very much linked to US financial market. And you remember the periods in which that we are talking, even the emerging and developing economies also linked up with the US financial systems because of so-called financial globalization. And there are a lot of other channels, including international trade and labor and other migration related considerations. So world is so much linked, where when the financial crisis is shaping up in US, everyone else also felt it, not like in 1929-39 period where it is limited. The US crisis was to some extent felt across Atlantic Ocean to the Western Europe. But now the 2007-9 crisis was felt across the rest of the world because financial integration, financial markets and other market possibilities, including real economic activities of trade and labor movements across the world, all felt. Okay. So you see with this, the high profile firms, big names in the financial intermediation started collapsing. The high profile financial intermediaries, I mean, there are many names. You see Bear Stearns, they started collapsing in March. Then Fannie Mae and Freddie Mac, these are the two biggest mortgage banks, mortgage intermediaries in US. They collapsed in July. And big investment banks, Lehman Brothers, Merrill Lynch, AIG's insurance, Reserve Primary Fund, it's a mutual fund. Mutual funds are like unit trust in Sri Lanka, and then Washington Mutual, another kind of mutual fund, all collapsed in September. So it's a big mess in US financial system. The financial assets of these agencies and rest of the financial industry as a whole is collapsing because nobody knows how much other financial intermediaries are exposed to these collapsed agencies. So everybody is unsure, not sure of the information that is available. The prices that they see in the market, they are not necessarily buying those prices for the consideration. They always wanted to discount even the prices which are determined through some element of supply and demand forces at half levels. So you see the difficulties, you see the challenges the rest of the financial industry is facing. Okay. So then, of course, how the kind of application, the solutions being proposed is the next step that we are going to kind of see. Any questions before I move on discussing this? Right. So we are seeing this developments, and then the financial stress being felt across the world, and then of course how to mitigate the impact, further deteriorating the US and rest of the world's economies, was widely debated, widely discussed across US House of Representatives. And then of course the US House of Representatives is the parliament. Okay, so then they voted. Okay, initially they have not voted the kind of a bailout proposed. So they have proposed almost $1 trillion. It's a $700 billion. Sri Lankan economy is only about 86 to 90 billion dollars. So you can imagine the size of the bailout they are talking in terms of US economy. And US economy also in 2008 was about $11 trillion, 9 trillion, $10 trillion during this period, the GDP, US GDP size. So more than 1/10 of the GDP being proposed to bail out these difficult financial intermediaries during this period. So what it again highlights is so-called moral hazard. So when you are in difficulty, taxpayers' money, if not new printed money, because by US Federal Reserve, so invariably new printed money would reflect in inflation, right? So effectively, it's the general public is paying for bailing out the financial intermediaries who had difficulties during this crisis period. So the original bailout package, which was not passed in September, was effectively passed in October 3rd. Okay. So then, of course, this recovery process not necessarily completed with that bailout arrangement alone. So the recovery was not in sight. Recovery was expected as early as 2008, but unfortunately, sorry, early as 2009, but it was not the case. It's extended. Further bailout in terms of stimulus, a plan was introduced, and that also close to $1 trillion was passed in early part of 2009. So you can see how difficult when the markets are collapsing, crashing, and how much resources the governments have to put into, but effectively it's the people, and their tax, if not from other way, you are paying through inflation, right? So you see the difficulties that the economies are experiencing during that period of time. So your information, I have again put down CDOs, collateralized debt obligation. So this is the financial product that we were talking in terms of financial innovation during the financial crisis period or prior to the financial crisis period. Where technically so-called CDOs created through a special purpose vehicle. So you create a SPV to create a CDO. Okay, so this SPV, that's a kind of a special package, repackage, a financial arrangement that buys a collection of assets. That's all the loans. Okay, the financial intermediary has extended, they've been kind of pooled into a SPV. and this is nothing new in terms of a corporate bond or a loan package that you have now created. Okay, so all these commercial real estate bonds and mortgage backed securities being pooled into a SPV. That's why I said mortgage backed securities that they created for subprime elements, Alt A, Alt B, different credit classes, okay, being pooled into the SPV. So the SPV is a specially created a vehicle for the CDO. So this SPV, okay, separates the payment streams, that mean cash flows from these assets into different buckets. That means high quality credit quality, low credit quality, in between quality. Different mortgage-backed securities are there. If you pool them on the basis of their credit worthiness, so they are servicing their loans through different interest rates, if not different arrangements. So they pool them on that basis, so that you have a cash stream. So when you have a SPV, within SPV you have different cash streams, and these are different tranches. So they sell these different tranches to different investors. Some are happy to buy high risk, probably earning a higher return. Okay, that can be sold to that type of investors. So what you see there is all these low credit quality payers settlement in terms of their regular payments being channeled to that product. So you are interested in assessing that to kind of get a higher return, you get the SPV tranche of that nature, right? So it's how this product's been packaged at that time. Then of course you see, sorry, within this pooled asset groups, you have a highest rated ones also. That's a good quality one. Okay, so these were senior tranches. Okay, if that is the best within that pool, you call it super senior tranche. Okay, so these were the asset classes being pooled. In the event of default or any difficulty, the super senior tranche being first paid off. You know, in the process of settling at times of default, to whom you pay first is there's an order of priority. So highest credit quality ones get settled first, and then you see lower credit quality ones settled on a stage-wise basis. And it's the same way if you look at when you wind down a business or a financial intermediary. First, you have to settle your liabilities. Ultimately, only the share owners, common share owners, equity holders, shareholders get settled from the whatever amounts retained with the organization. So similarly, when the CDOs are having difficulties, super senior tranches get priority. Okay, lowest tranches of CDO is the equity tranche, and this is the first set of cash flows that are not paid out if the underlying assets go into default and stop making payments. This tranche has the highest risk and is often not traded, but still that's one part of SPV, because those were the ones who bring in higher inflows. But unfortunately, high risk, this is a subprime group being pooled to one element. So when a financial market crashes, they are the ones first run away. They are not in a position to settle their obligations. So they leave their assets and run away, right? So the amounts that were receiving into SPV from this subprime group is now not received by the organization. So organization has to still pay to the super tranches, because other different tranches that they have created are settling. So you see, the financial industry had these innovations to the extent where they have pooled these different credit qualities into different mortgage-backed securities, and then these mortgage-backed securities being created through SPV into different tranches and sold back to other financial intermediaries for their investments. So those investments bring returns in terms of tranches. Best credit quality, yes, you have a priority in terms of settlement, but your return is lower. Whereas lowest credit quality have a higher return, but often not being purchased by many simply because of the risk involved. So you see how much the innovation has peeped into in terms of these arrangements. Okay, so before I get in and detailing out the real empirical market circumstances during the financial crisis of 2007-9. Any questions? You can put them down and pass it to me so I can see it and respond appropriately as we discuss on. Right. Right. You see here the housing price behavior prior to the crisis, as I was highlighting. Again, this also being presented as a price index, where 2006 Q2, where the prices were basically at peak, being maintained as 100. You see, up until second quarter of 2006, the prices were only one directional. It is increasing. It is increasing. So anybody purchased in 2002 see that it's increased substantially by 2006 Q2. And then you see the next phase after some disturbances, agency problems peep in. So the curve is flattening until a mid part of 2007. So you see a one-way direction of increasing that you have noted is reasonably flattening during this period of time, and the levels that you are experiencing there is not much deviated from its peak, but not showing the one-way direction of increasing that you have noticed all throughout prior to the problem setting. And then you see the prices started crashing down, and by 2009 you see the prices have dropped more than 30% of its peak due to the subprime market-driven financial crisis during this period. And please remember, this drop down halted to some extent at 30% or so because of bailouts. Because of bailouts that we discussed, big numbers, trillions of dollars being pumped in by US regulators and the government. So that balanced out the crashing down of the financial markets assets during this period. But effectively, markets were really panicked during this period, and the prices were really going down in the US during this period. So while this being said, there were arguments also within US policymakers inside the Federal Reserve, okay, who is responsible for this housing price bubble. Whether somebody requires to be blamed, the Federal Reserve, or it's the general circumstances. This was argued inside the Federal Reserve as well as outside, and you may still read literature arguing for and against. Why Fed being argued is some economists argued that low rate interest policies, I mean the interest rates were kept quite low for extended period of time by Federal Reserve until the prices started kind of started crashing. So you see a low interest rate environment maintained by the Federal Reserve has contributed to one argument. They argue that it has contributed to a so-called buying spree in houses, mortgage products in US, and to some extent to reduce the stringent evaluation processes applied in loan extensions. So cost of financing were kept at low levels by policy authorities was the argument here. Then the Taylor, that's the books, argues that Frederick W. Taylor, I mean, this is the Mishkin's book that we are referring. You probably read and you can see here. A famous economist, Taylor, argues that the low federal fund rate, okay, led to low mortgage rates. Okay, so because of that, federal fund rates were low, so the financial intermediaries can fund their financial requirements from Federal Reserve at a low level, and this has led to low mortgage rates that stimulated housing demand. So everybody else could now access the financial intermediaries and have a financial facility at low interest rates, okay, and encourage the issuance of subprime mortgages. Because of low interest rates, everybody is accessing some relaxation of evaluation of loan applications. So they are not necessarily stringent under normal circumstances, like, so they have relaxed the application evaluation circumstances, which led to kind of continuous increase in prices, housing prices, and contributed to a bubble. So that was the argument people were trying to kind of put forward for the policy environment prevail in US during this period. But at the same time, there are argument against, and Bernanke, one of the very respected Fed chairman. He was the Fed chairman for 8 years continuously. I mean, he started during the period where President George W. Bush was first in the office, and then he continued even under President Barack Obama's time as the chairman of Federal Reserve. So he was very clear in arguing that it's not necessarily the maintaining low interest rate by the Fed Reserve, and the culprits he identified were the proliferation of new mortgage products that lowered mortgage payments. In fact, he has all this financial innovation, new mortgage products, that's what he is arguing, that reduced the mortgage payments by the borrowers. And then he argued relaxation of lending standards, right? That's what we were telling repeatedly, we were discussing repeatedly. Even the people who were on illegally kind of moved into US through borders, Mexican border, whatever you call it. So they all were facilitated in terms of mortgage products, but they effectively have no PR or citizenship, even a permanent employment. They were working like helping hands at different places. So they've been extended. So the argument is new financial innovations in the form of mortgage products, and also not being adhered to lending standards. Okay, so that brought in more buyers, and then capital inflows, as we were mentioning, from emerging market economies, all from East Asia, the Asian countries, the Middle East, the Africa, the Europe, the Latin America, all moving in, and they're buying assets in US, right? So this were to blame is the argument that the Chairman Bernanke has brought in, and whether the debate monetary policy was to blame for the housing bubble price, even up to today, it's not resolved. So some argue for, some argue against. So there are arguments also we might see as we move on in next lecture that we probably start next week. Also, we would see macroprudential supervision that we will be discussing, so regulatory aspects. So you probably see the argument would continue on that basis. Okay, so this is how the elements were discussed and detailed out. And then another empirical evidence is the stock prices. So you can see here, early 2000s to even at the doorstep of financial crisis in 2000, latter part of 2007, stock market was on a kind of a trajectory of boom, increasing prices. Again, we are looking at Dow Jones Industrial Average. So you see 2007 has been taken as 100 here. The prices were on a continuous increasing trajectory, but you can see now from 2008, latter part of 2007 to 2009, prices have fallen up to almost 40 levels. So it has basically kind of lost half of its value. Okay, so significant reduction in prices was noticed here in terms of asset market in the US. And then the credit spreads, right? So BAA versus US Treasury spread. We were talking about BAA and US Treasury spread. You see, generally it was more or less about 1.5% in normal circumstances, but then it's hitting almost 6%. So you can imagine the explanation where the credit contracts tightened during this period because of the uncertainties with respect to the levels of economic activities. Okay. Then you see this type of elements playing across these markets on a continuous basis. So any questions of advanced economy experience that we were discussed so far? In fact, even today, there's mortgage-backed securities and CDOs exist. Yes, there's a question on that. Yes, it exists in US as well as in other advanced and emerging market economies. Even in Sri Lanka, to some extent, mortgage-backed securities are there, but not widely kind of quoted, traded. It's like over-the-counter, OTC kind of trades. These are there, but what you are seeing now and what you have not seen in 2006-07 period is the lending standards. So when you see CDOs or MBS being promoted during that period, nobody worries about what's the underlying asset which powers this SPV, if not CDO. What is underlying assets for these transactions? But now people are much more mindful, and that has kind of created number of repetitive layers of CDOs, repackage, sell, be limited, not necessarily unendingly it's been expanded. No. So that's the change what you are seeing in today's per se. And today, of course, to some extent, they also look at these CDOs not by pooling one type of asset class, like mortgage, real estate mortgage, no. Real estate mortgage, international trade, risk-free, sovereign, if not international bond issued by high creditworthy governments, yes, countries, all like different asset classes being brought in. Okay, commodities being brought in. So thereby diversified the risk. So one type of market collapses, then you can rely on the other. So it is the kind of diversifying the possible risk associated with a financial product of this nature. But anyway, I mean, it's a good question, and it sees that products, financial innovation, being more defined, if not much more orderly in circumstances like now in comparison to the crisis, where the lessons have helped regulators and markets to kind of design and define their assets in great shape. Any further questions? Because I simply see this is a good point for us to stop, because we can start from emerging market experience next week. Because we talked all about advanced economy experience at today's discussion. So if you have further question, I can clarify. If not, we can pause at this point and start our discussion next week. Okay. If you have any question, please just drop a mail. I can follow up on that basis. Yes. There's also kind of a similarity in terms of lockdown and but recent lockdown and the financial crisis of 8-9. Of course, what we are simply seeing is the magnitude of impacts are global in nature. So in both circumstances, the pandemic is global and financial crisis also global, and the effects have widespread. But the difference is it's health related now. But the 2008-9 is mainly the financial markets and economic related, right? So ultimately, health related has poured into the economic related circumstances across all the countries in the world, where global recession, global economic downturn is expected in 2020. IMF also projecting the economy, global economy, to go down, and then of course many measures across the world in terms of helping out, not necessarily bailing out as such, but then packages being introduced to help agencies who are in difficulty and who is having difficulty in access the normal financial intermediation. They have facilitated loan extension, moratoriums, all kind of facilities being also introduced. And the other element is the employments. In both cases, there's substantive employment loss, but that is economic reason, where economies are not performing at its usual pace even now. So people have lost jobs, and it's expected that the current the lockdown or the COVID-19 related developments also would not necessarily bring back the normalcy in economic activities immediately. I mean, would take many months going forward. I mean, we would not necessarily see you are returning to normal, but what is new normal now is you had to kind of follow through some measures of health guidelines for your operational activity. So effectively, similarities are, these are all global in nature, no boundaries being defined. So continuously seeing the uncertainty in terms of economic activities, but it is that economic information that was discussed in 2008-9. Now it's the health, social information that's been looked at. But at the same time, the challenges from that to the economic aspects are very much there. Employment loss, economies are at recession, economies being introduced with a lot of measures of support. Yes. Any further questions? Right. So if not, we'll stop at this point, and we can start with emerging market experience in our next discussion. Thank you.